Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-string support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. This week's edition of the Moneymakers podcast is based on the presentation that I gave at the Master Investor Show last Saturday, where I hosted a session with Peter Hewitt, the recently retired fund manager at CT Global Managed Portfolio, a man with more than 30 years of experience in the investment trust business. Master Investor Show happens once a year and is a flagship event for private investors, and also a number of professionals I met there this year as well, interestingly enough. If you are a subscriber to the Moneymakers Circle, you will be able to see a copy of the slides that I presented, along with some more backup slides that did not make it on the day, but which I think will help to put in context what's been going on in the investment trust sector over the last couple of years. So here we go, on with the recording of the presentation. I'm here delighted to be joined today by Peter Hewitt, who's a good friend of mine, a Scottish fund manager who's retired from actually managing funds last year and is now on the other side of the fence, except in a couple of respects. He's a director of a couple of things, including the AIC and Odyssean Investment Trust. And I can't start without mentioning that in the audience is the original co-host of the Moneymakers podcast, Simon Elliott, who's gone on to greater things, I suppose I have to say. Anyway, so what are we going to do today? We are going to be talking about investment trusts. From the buy side, I suppose. You've heard a lot of pitches today from investment trusts. So I'm going to try and give you, with the help of Peter, if you like, a consumer perspective on investment trusts. Very important sector, big part of the all-share index, not totally understood by the FCA and regulators, I think, could do more to help. We're going to talk about a lot of things, but basically we're going to start with my 1-minute slide showing what's happening in the macro world as far as investors are concerned. So I'm going to start today with looking at this simple slide, which is one I put in every year in the Investment Trusts Handbook. And basically it just shows that despite everything that's happened over the last few years, we've had COVID, we've had more recently the Iran war, we've had the inflation shock, we've had interest rates going up, we had Brexit at the beginning, 2016. The equity markets have delivered something which is very much in line with their long-run historical average. They produce positive real returns, that is over and above inflation, which is what investors are interested in. And they've done it by a pretty handsome margin. So over the past 5 years, the FTSE All-Share Index has returned 6.2% in real terms above inflation and 5.4% over the past 10 years in real terms, which is very much, as I said, in line with long-term experience. So whatever goes on in the world, there's always a bias towards investing in equities. Don't be put off just because there's a lot of scare stories in the media. There are moments like at the moment, which I'm going to ask Peter about. The Iran war and Mr. Trump have thrown a large dollop of hitherto unknown risk into the markets because he doesn't seem to know what he's doing half the time. And that makes it very difficult for investors to react to that. So basically, the one thing you didn't want to own in the last 10 years was gilts. They have delivered a negative real return. Over time, the long run, they tend to produce about 1% real return. They've actually produced minus figures over the last 10 years, and you all know the reasons for that. But that just reflects one other factor which I'm going to mention. I'm going to bring Peter in, which is that I started this business in the 1970s. In 1981, we saw the start of the 40-year bond bull market when interest rates came down. When I got my first mortgage, it was 16% interest rate, and they went all the way down pretty much to 1 or 2% about 4 or 5 years ago. That cycle has gone, and that's one of the main reasons why we're seeing what's going on in the world at the moment. But equities have lived their way all through that. So Peter, what I'm going to ask you first, if I may, Peter's been in the business for 30 years or more, Scottish fund manager, as he may remind you, worked at all the best firms, Ivory and Syme, Murray Johnston, and more recently Columbia Threadneedle, and a great expert on investment trusts. So Peter, my first question to you is, we all know what's going on in the world. If you were still managing money, and even now as a private investor, how do you think about managing during periods like this when we've got a lot of turbulence, a lot of negative headlines, but the markets keep going up? They've hit all-time highs in America.
In terms of trying to make new investments, all I would say is you've got to try and have a medium to longer view of things. Nobody has a clue, to be honest with you, what's going to happen in the next week, month, quarter. Certainly, if what's going on in the Middle East at the moment is prolonged, it will become quite a serious issue, and I suspect equity markets will readjust downwards, maybe quite sharply. The way they're acting at the moment, particularly in America, it's as if this will be resolved quite soon. I have no idea on that. So if you're buying something on Monday morning, the last thing you should be doing is, well, what's going to happen next week or next month? Because honestly, you might be right. They might push on a bit further, or you could be seriously wrong if things started going the wrong way in the Middle East. So I would definitely have a medium to long-term perspective. And by that, I mean probably at least 3 years, probably 5 years. Where do I think this particular trust, with the manager and the asset classes in, where will it be? Do you think they'll generate returns, positive returns over that period? And not to try and get overly fixated on the Middle East or even politics in the UK at the moment, which is horrendous.
One practical conclusion of that is, I know what I've done about it. I have actually put a bit more into cash because I think Trump represents what I would call a significant risk with a high impact. If he gets this wrong, if the war doesn't go well, it could have a very negative effect. So I personally have put some more money into cash and so on. I don't know if you've done anything, Peter, in the last month or so, have you?
Yes, a little bit. Probably raised a little bit of cash, but no more, because I want to try and hold the investment companies I've got in my ISAs and SIPs and actually hold them for the long run. Because to be honest with you, trying to time market moves like this, you might be right, but to be honest with you, more often you're not. So hang on is what I would say.
And the US markets, obviously, we know, looking very richly valued. That is a factor. So very quickly on investment trusts, how are investment trusts doing? This is the performance relative to the all-share index. You might think that's a pretty easy target to beat, but as I said before, it's actually done not too badly, the all-share index. Investment trusts had a glorious period between 2019 and 2021, where almost half the sector was trading at a premium. Hard to believe now. So we've had a correction since then. Higher interest rates have led to discounts widening, and the outperformance has narrowed over this last year. But basically, investment trusts over the last 10 years, they had 5 good years and 5 bad years, essentially. But they are getting better now. And one of the reasons for all this underperformance, or relatively underperformance, they've all made money, but relative underperformance, is due to discounts. And this chart just shows the average discounts over the last 10 years or so, a bit more. And basically, as interest rates went up, these discounts widened. And now if you exclude 3i, which is a special case, very large, distorts the index, from this low point, discounts have come in. They've come in from a low point around 18% to about 11, 12%, something like that. So it's getting better. But there's still room to go. That's the other good news. There's still room for it to go. Now, since the last Master Investor show, could you have made a lot of money out of investment trusts? Yes, you could, if you picked the right one. Suppose you went for some of the themes that Jim Mellon was talking about, then you could have made some significant money out of investment trusts if you'd actually put the money to work. It was admittedly just a few days before Liberation Day, when Trump imposed unilaterally all these tariffs on other countries. But here you can see there have been some significant performers since that period. Anybody who's a subscriber to the Moneymakers newsletter will see all these slides and a lot of extra ones that I put in to give a kind of context around this. So you could have made 100% if you'd gone down the commodities theme. Seraphim Space, that's the sort of hot stock of today because it's very highly exposed both to space and to defense spending. That's on a huge roll, and they're going to do a C issue, what's called a C issue soon, which is, I'm sure, going to get a lot of support. Peter can explain to you what a C issue is. But equally, you could have lost a lot of money. These are stocks that have actually lost a lot of money, and there have been a few disasters in there. Digital 9 Infrastructure is a particular favorite of mine as an example of a trust which raised a huge amount of money and is now trading as a penny stock, though shareholders have had a little bit of a payback since. And also at the bottom there, you can see HT Capital. That's probably the only really surprising name on this list. Wonderful private equity trust that's done very well over the years, but has a very big exposure to software. And when we had that AI is going to kill the software scare, that was damaging. So we're going to talk about Saba Capital in a moment. But Peter, I just want to get your comment on where we are in the investment trust cycle based on your experience over all these 30 years.
Well, your 10-year chart was interesting, Jonathan. Actually, you could have extended that to 15 years because from about 2010, as we recovered from the GFC through to the end of 2021, investment companies outperformed the mainstream equity market almost every year. Fantastic place to be. And that's helped by discounts gradually tightening from well into double digits to at the end of 2021, almost par, 1 or 2% average discount. And I think more than a third of investment companies sold at premiums. So that was a great period to invest. You did well. Since then, we've had really 4 and a bit years where discounts have widened. NAVs have not been performing anywhere near as badly, but the share prices have underperformed. And Jonathan hinted at interest rates going up. And actually, you may recall the Bank of England increased interest rates by 0.1% just before Christmas 2021. And that was it. And then you had the Ukraine war, inflation took off, interest rates went up a lot. And actually, sectors like property, private equity to some extent, alternatives like renewables and infrastructure, where the valuation of the NAV is linked heavily to gilt yields and discount rates, they become quite complicated. But let's just say it was very adverse. And you had the widening of the discounts. Also, even on mainstream equity funds, we had a very bad year. I can't remember if it was 2022 or 2023 in the equity market, which was a down year. So where are we now? I mean, Jonathan was right. The widest discounts were at the end of 23, early 24. And since then, they've gradually tightened. Not massively. It's still 11 or 12 as the average sector discount. For equity funds, a bit tighter. I'd say the average discount was probably 7, 8, maybe 9%. But you can still get wide discounts. Private equity, renewables, another area, and property are still at massive discounts, 25, 30% plus. And actually, the other thing to mention is that's also partly been due to a lack of demand and too much supply. And when you get that situation, then share prices ain't going to rise and valuations ain't going to tighten. And now there are reasons behind that which we can discuss, but that's been another factor in the underperformance. My feeling now is we've definitely bottomed. I don't think there's any doubt about that. Even if the market has a major fall in the next quarter because of what's happening in the Middle East, discounts may widen a bit, but they're not going back to where they once were. And that's because boards of investment companies are far more active in terms of share buybacks, trying to stimulate demand by communicating better, let's hopefully, but capital allocation policies, which is what that comes under, has been improved massively. So I don't think we'll go back. What we want to get is gradually things getting a bit tighter, and that's when you get share prices outperforming.
Indeed, I would totally share your view. Now, we can't go much further without talking about Saba Capital. Saba Capital is a US activist hedge fund run by a guy called Bose Weinstein, and he has launched, I can maybe describe as a kind of invasion of the UK investment trust space, building stakes in 40 different investment trusts. So that's about 15-20% of the whole investment trust universe. Because he spotted these discounts. Turns out he didn't know very much about investment trusts when he started, what they actually were or the individual qualities of the ones he was buying. But he did see a big discount, and he decided to get active with all the ruthlessness that you'd associate with a New York hedge fund guy. He's gone after a number of trusts, and most of you will be familiar with that story. He's invested a total of about $2.5 billion in the sector in total, which is a significant chunk of money. And my view is that net, he's not a very nice guy probably. His tactics have been open to question and has caused a lot of anxiety around the place, particularly in boardrooms. But he has undoubtedly had an impact in accelerating that process that Peter was talking about, making boards wake up, smell the coffee, and make sure that they are doing something for the shareholders. They're aligned with the shareholders. And if it's a mismatch of supply and demand, there's only two things you can do. You can either find new demand or you can restrict the supply. And boards have been trying to do all of those things, both recruiting new investors or trying to, but also doing share buybacks and so on. Lots of other measures you can do to try and reduce the supply and reduce that imbalance. Very interesting. They've had a number of successes already in terms of basically forcing boards of trusts either to merge with another trust or to offer a rollover option into an open-ended fund, but basically to narrow the discount and give shareholders a chance of an exit. One or two, they Keystone Positive Change, Henderson Opportunities, and so on. Henderson International, that's merged with another trust. Smithson was converting into an open-ended fund, giving shareholders money back on the way, and so on. And we recently had a BlackRock, smaller companies, BlackRock, Swan Morton merger. But they're still active in a number of places. Peter, they're particularly active in a couple of trusts down here, Edinburgh Worldwide and Impacts Environmental, where their activities have caused a lot of anxiety, but they're also close to producing a result. And perhaps you could just explain briefly, Peter, what they're doing there.
Well, yes, they've got big stakes in those companies, and it's been quite difficult for the boards of these companies because they've tried to communicate with Saba, which has proven to be not very successful, and they've ended up having to try and have a tender offer for, say, 25% of the shares, try and get them off the register, tender being often priced at close to asset value. It's a big uplift in the share price. Saba hasn't bitten at all there, and that's one of the reasons why they are quite as unpopular as they are. An activist investor, and there are loads of activist investors, like to try and spot a wide discount and then encourage the board to try and close that discount, often through a corporate action, maybe a tender, or a big share buyback program to close the discount. And they will buy on a wide discount and hopefully sell on a tighter discount. That's fine. That's capitalism. That's probably quite healthy. In the case of Saba, though, what they want is not just that, but they want the management of these trusts. They want the assets. They want the management fees. And that's kind of not so attractive. And that's what it looks like they'll succeed with Impacts Environmental. The vote on Edinburgh Worldwide, I think, is happening next week, so we'll see what happens there. But that's a lot of assets that they could have under their control, and they would use that to deploy into buying more trusts that are at discounts and trying to cause havoc.
Indeed, and that's what they finally said. Well, what their intentions are is to take control of the boards, throw out the existing directors, appoint 3 independent directors that they've put forward themselves, who may or may not be deemed to be independent, and then run the money themselves and use it to put money back into other situations where they're involved. Interestingly, these are the ones where they've recently, in the last 3 or 4 months, been increasing their shareholdings. And it's a very interesting list. You might want to ask yourself, do you want to get involved in those situations or not? Is that a profit-making opportunity? Well, I think the lesson of the last 2 or 3 years is that if they get 5% on your share register and you don't do something as a board pretty damn quick, before you know it, they're going to be at 10%, and before you know it, they're going to be at 15%, because there are people out there who will be willing to sell you their shares at that price, and they include wealth managers and people like that. So we heard from Henderson Smaller in this room a bit earlier. They're now up to 12% in that trust, where the manager recently retired, the long-serving manager, new ones come in. And all these other trusts where they've actually built up quite significant stakes, and some of them are pretty big. I mean, Pantheon and Allianz Technology, they're both very large investment trusts. One's in private equity, the other one is a tech stock. Peter, would you be tempted to invest in any of those purely because of Saba's involvement?
Personally, no. I don't think they would succeed in all these cases anyway. And it would be interesting to measure, have they been good with Impacts and Edinburgh Worldwide share prices? I think the Edinburgh Worldwide share price has performed quite well, but that's because the underlying investments that Edinburgh Worldwide have got, which didn't perform well for a long period, has now had a fantastic last 12 or 18 months and has really motored up more than 40%, I think, in terms of the NAV. So I'm not sure I would be buying just because Saba have taken a stake. There is no guarantee that it'll all work out swimmingly for them, and you don't want to be on the wrong side of Saba if they started to sell.
You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector each week and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content weekly newsletter, now available with a 2-week free trial. There you'll find our in-depth independent profiles of more than 200 investment trusts and much more content. Go to money-makers.co/circle for more details. If you like this podcast, do please subscribe to the channel and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Find all those links on the website, money-makers.co. Well, we're getting on next to the bit I'm sure you're most interested in, which is, when I sat down with Peter earlier this week, I said, what sort of investment trusts would you think look interesting at the moment? You know all the blurb. We're not making share recommendations. We don't know how crazy you are when it comes to investing your own money. So we don't know that. But these are some names that Peter mentioned or put down on a piece of paper, and I've added a few of my own, which I think are quite interesting. So let's start off with UK equities. I'll translate. FSV is Fidelity Special Values, TMPL is Temple Bar, and LWDB is Law Debenture. And two of those are in the UK equity income sector, the second and third, and the first is in the all companies sector. So, Peter, tell me why you've put those names down.
Well, the one point I'd like to make about those three and quite a few of the others is it's not about discounts. I mean, it's great if you find a super investment trust that's on a wide discount, you buy it, it performs strongly, and the discount closes. But actually, it's helpful. Yeah, we love to do that. But by far the most dominant driver in outperformance of the share price is what happens to the NAV. How well has that performed? And in the case of Fidelity Special Values, he's a fantastic UK equity manager called Alex Wright, who works for Fidelity. And he's really trumped the UK market for the last really 4 or 5 years. He's got very clearly well-defined investment approach. It's selling at par. Doesn't bother me a hoot. On a 5-year view, 3-year view, I'd be buying that again right now. I think the common link between all three of them is there is definitely a value bias to the underlying investment strategy. Temple Bar, I mean, you look at the names in the Temple Bar list and you think, oh boy, okay, there's BP and Shell, but a lot of it's big FTSE 100, pretty boring companies. But they've generated some unbelievable returns the last few years because they've focused on cash flow, dividend yields, share buybacks, and the result is in picking often companies in very unexciting areas, they've generated some super returns. And I would say they have a deep value approach. Law Debenture is just a great long-term. It's run by James Anderson, who's the fund manager for that. It has a separate financial services business, which does very nicely, thank you, helps pay the dividend. But all three of them, if you look at them in relation to the all-share index, have strongly outperformed. And I think they will continue to do that. And it doesn't bother me that all three of them are selling round about par. I'm just going to segue on to smaller companies there because that's UK smaller companies mainly. And there's a couple of names there that I chose for Jonathan. If you look at the third one, there's the JP Morgan Smaller Companies Fund. I just think this is a super stock picking fund. It's run by Lady Georgina Britton, who's a very experienced fund manager. And when markets are halfway decent, JP Morgan UK Smaller Companies seriously outperforms. It's on a discount actually of 8 or 9%. It's got a decent dividend yield to it, but it's one that I would definitely lock away for in better times that will really deliver well. And then Odyssean, which was presenting earlier, and I've got to hold my hand up because I'm horribly biased here because I'm a director of Odyssean. But to be honest with you, all I'll say is have a look at it. It's well poised. It's the top performer at the moment, and it wouldn't surprise me if it continued to be. And just look at the way the directors are buying that. And so if we move on to some other ones, emerging markets, which Jonathan mentioned, I think these are two really good generalist funds, Templeton Emerging, the Fidelity Emerging. And clearly emerging markets have underperformed, particularly the American market, for long enough. That changed last year. They are genuinely quite cheap. There's very strong growth from a lot of them. China is delivering decent growth, as is some of the other Asian markets. These, though, personally it's a bias. I don't like buying single country funds. I prefer having a well-resourced manager, a generalist approach in emerging markets, and these two I think will deliver some really good returns. They're both at decent discounts for you. Then I've got growth there, Scottish Mortgage, Allianz Technology. I mean, there are different reasons. Scottish Mortgage, boy, what a recovery. It had a fantastic run for most of the decade from 2010 to 2020, got up to £15 a share, unbelievable. By the middle of 2022, it was down at £6 a share. This is the biggest investment trust. I mean, it's 15, 17 billion. It's well into FTSEs of half the value of Tesco. But it has recovered and some. I think it's over £14 now. Great private equity exposure, huge holding in SpaceX, and access to some companies you just don't see anywhere else, some real growth companies. Allianz Technology is simply put a play on technology. I think it's quite a well-run company, and I would always have one holding which was an exposure there to technology. The other one you've got there, EGL, is the Ecofin Global Utilities Infrastructure Trust, and it's more a steady growth, but it's investing in lowly valued utilities globally. It's got a decent dividend yield of nearly 4%. The discount has closed. It's now at par. They issued shares last week. I don't think that changes my view on things at all. I think it should be selling where it is. But it's a great beneficiary of technology in the sense that it owns quite a number of companies who are involved in the building of and running of data centers, which of course is key for artificial intelligence. So watch out for that one. And well-resourced manager, experienced manager. Then we've got some yielders. New City High Yield is corporate bonds, mainly 9% yield. UKW is Greencoat UK Wind, so that's the biggest renewables company. It's been a dreadful performer, really, in recent years. But I think the dividend will be maintained, and the dividend is yielding over 10%. So if you're looking for yield, there's two there that you could nail your colours to. Let's just move on quickly to private equity. And I attended the Oakley presentation. I own that one personally. I think it's one of the more interesting private equity trusts. It's trading on a 30 discount, if discounts are important, but it's had a great record of NAV growth, which I think should be sustained. So that's just a kind of summary of a few of the names there.
So I added some just to add a bit of spice into it, because I know people like spicy ones. But, investment trusts are really ideally and predominantly vehicles for long-term saving, essentially. You want to buy them, you pick the best managers, you pick them in the right areas, and you hold them for a long time. And you look for opportunities to add them when they maybe start trading at a wider discount than they normally do. That's a very good strategy. But there are people who look for very exciting, spicy things. I mentioned SSIT, that's Seraphim Space. That's very much a hot stock at the moment. In fact, the best performing investment trust over the last 12 months or so. And that's on a tear. It was launched at 100p. It went all the way down to 40p or something while discounts widened. And now it's back up. It actually shot up to £1. And then in the last couple of months, it's gone up to £2.40. So, Peter, can you explain the C-share issue? What is a C-share issue? And should you be looking at a C-share issue? Should you be subscribing?
There's not been many C shares for quite a number of years. There used to be lots. But it basically is the issuance of a separate share class, normally priced at 100 pence. And you buy the shares, and then it just allows that separate amount of share capital to be reinvested in the main portfolio. So in the Seraphim space, I think it's about 400 million now. Let's say they raised 100 million. They would do that in a C share, and they would then take a while to get invested in the mainly private companies. And once that investment was done, the C share would merge in with the ordinary shares. And the one thing I'd say about Seraphim Space is, although it's space, it's really about defence. And so it's drone technology, electronic warfare, all that sort of stuff, which, courtesy particularly of the Ukraine war, is in hot demand.
I think the important thing to mention, though, is that if you buy a C share at 100 pence, and it then converts into the main thing, it's not going to convert at 200p. In other words, you're not like you're getting 200p's worth of value for 100p laid down. It would be lovely if that was the case, but that's not how that works. And indeed, you might see the £2 come down a bit when they actually do merge. A couple other things I mentioned. Cordiant. If you listen to the Moneymakers podcast today, we had Stephen Marshall, who's the basically founder of Cordiant, on. That's been another very successful trust more recently. A good example where you could have picked up a really interesting proposition at a very big discount, still on a 20% discount. A very interesting company involved in building what he calls the plumbing of the internet. So we're talking about mobile phone towers, we're talking about fiber optic networks, and we're talking about data centers. So they build the data centers in some very interesting countries across Europe. So Poland, Czech Republic, places like that, which are coincidentally the fastest growing countries in Europe, or among them anyway. Very interesting one. I recommend if you want to have a listen to that, you might be influenced by that. I mentioned Biopharma Credit. This is a trust that lends money to early stage pharmaceutical companies. That's on a yield of about 9%, I think, at the moment. I've only ever had one investment really go badly wrong, and that did knock them back a bit. But that's an interesting vehicle. The biotech sector has come back very strongly in the last year. It's done nothing for about 5 years before that, but it has come back very strongly. That's another one perhaps worth looking at. Robert Kennedy Jr. has not yet destroyed the industry in America and seems to be doing some sensible things now. And then, HarbourVest. Well, you might have heard HarbourVest talking today. The only reason I put that down as being interested because the board has been very active in coming forward with proposals to try and return more money to shareholders in a variety of different ways. They're sort of balancing act. I actually personally bought that one last summer. That's done quite well. It's up about 15, 20%, something like that. Nothing great. These things are quite large. It's a fund of funds. They wouldn't normally own it, but it seemed to me like the board was doing all the right things, and it has a continuation vote coming up in the summer, and that's quite an important trigger for boards to get busy, where they suddenly look ahead and see continuation vote coming, where the shareholders get to say whether they want the trust to continue or not. They say, blimey, we want to do something here, otherwise we're going to be out on the street, out on our ears. So these are just a few names. I just want to emphasize this point, though, that investment trusts are long-term vehicles, and that's how you're going to make the most of your money out of them. But there are times, and there have been times recently, when you can use the discount to your advantage. You get that nice double whammy of the NAV going up and the discount coming in, and that will give you an exceptional return. But I don't think it should be more than like 10% of your money doing that kind of thing. I don't know if you agree with that. So these are some other specialist situations you may have heard about. They aren't mainstream. They're not general exposure to regions or particular asset classes. They're all doing something specific. Jim mentioned Nippon Active Value Fund. That's been one of these trusts that actually is activist in Japan, taking advantage of the corporate governance changes there, which are ongoing. That's done very well. And I'd like to give a mention to a show called White Oak Emerging Markets Trust, because there have been very few IPOs in the last 5 years, or almost none in the last 4 years of any significant size. In other words, we're not replenishing the investment trust world with new companies. We've lost about 20% of the universe, but we're not replenishing. And we won't be able to say the investment trust market has revived fully until we actually see new ones coming to the market. But there are a couple, Ashoka White Oak Emerging Markets is one of them, which have said, we don't care about this. We won't be able to raise a lot of money at the beginning, but we're going to start very small. I think it started at 30 million or something. It's now up to 68 million. And it's performing quite well. And sometimes those situations can be interesting. There's another one called Onward Opportunities, which has just joined the main market. Very smaller companies fund. Interesting little vehicle. So you want to keep your eye out for those sort of things. I was quickly going to mention this thing about platform costs. Many of you may have noticed that Hargreaves Lansdown, which is the largest platform for retail investors, recently changed its fee structure. It's got an awful lot of headlines for that, mostly negative. And as a result, there was a thing in the paper last week saying that £3 billion has moved from Hargreaves Lansdown to other platforms, notably Interactive Investor or AJ Bell. One of the things is that Hargreaves Lansdown is now owned by private equity. Now, you might think that's good or you might think it's bad, depending on your view of private equity. But the one thing you do know is they're not stupid. Okay, they're really not stupid. And one of the great anomalies with Hargreaves Lansdown was that you had your ISA and your SIP, but if you actually had a fund and share account, they didn't charge you any money for having it. So you could have all your non-ISA, non-SIP money in a fund and share account and not pay anything for it, apart from dealing costs. Now, Hargreaves Lansdown could have argued, or perhaps did argue, that's a way of attracting people to the first step. But they want effectively to get rid of those people. They want people to pay to make it worth their while. But if you do that, you can end up significantly cheaper. So maybe some of the people who've moved, I don't know, has anybody here moved some money from Hargreaves Lansdown to another place? Yeah, a couple there. Well, it'll be interesting to see how that works out for you. I mean, it depends how big your portfolio is. It depends how actively you trade and so on. But you can at least do some analysis. And I would suggest you do. It might be worth it, having a look. There's quite a good website called Boring Money, which does those kind of surveys. The AIC has some numbers on its website as well, where you can compare costs for different size and types of holding. And interestingly, they don't agree. So that's quite interesting. Mm-hmm. So you do need to do a bit of homework. But I do think that's quite important, because the cost of investing, if we just mention the big competitors to investment trusts, in my view, are not open-ended funds. They are passive funds, ETFs, and now we're seeing active ETFs come to the market. Okay, and they are cheaper on the whole. Investment trusts always used to be sold on the grounds they were much cheaper than open-ended equivalent. That's the big competitor to investment trusts, I think, today. And every time you make a decision to invest in a certain asset class, you should, as a matter of course, I think, compare what you're buying with an equivalent ETF or passive vehicle, if there is one, and if it is equivalent, because there might be a better bet for you. I own a few. I don't own any investment trusts, but I own a few. So it's important to keep costs on your mind. And the great Jack Bogle, who started Vanguard, the first big passive investment fund, he always said, Forget about the efficient markets hypothesis. You want to focus on the costs matter hypothesis, the CMH, because every percentage of 1% that you give to the fund management company comes out in your return at the end. And so therefore you want to get the very best fund management companies, some represented here, JP Morgan I can happily mention, and others that Peter's been involved with. Costs do matter. So it's well worth having a quick check of where you're holding your investment trust. So this is a couple of final slides before we release you. You've done very well to be here so late in the afternoon. The sector's shrinking, and there's still more to come. I mean, Saba Capital aren't going away. Boards are having to jump through hoops. We've seen a lot of deals, but there's still a few to come. I'm sure Peter and Simon would agree on that. We haven't had any significant IPOs for 4 years. We need them in due course before we can say the investment trust market's really revived. Saba and others are looking at alternatives now where the discounts are wider. They're still much wider in alternatives than they are in conventional equity trusts. Personally, I think Saba Capital net has probably been positive for the sector by giving a kick up the backside to some boards. Some boards have been very early, proactive, done well. All investment trusts are actively managed. And as long as active management continues to underperform passive management in aggregate, it only underlines the need to. Most fund managers are dying for this whole AI Mega 7 thing to stop, because basically some of them aren't even allowed to own a market weight of them. And so that's really punishing their performance. So they're dying for those stocks to lose value. There's been an issue around cost disclosure, some of you will be familiar with. That's not quite resolved yet. But we can say absolute performance has been good. Average investment trust up 21% since the last Master Investor show. Not bad. It's about in line with the all-share index and slightly ahead of the US index. Where there's an equivalence, investment trusts are outperforming open-ended equivalent. So if you've got a UK equity income trust and you've got one is an investment trust and another one managed by the same firm, the same manager, okay, the investment trusts are on average outperforming, which is what they have done historically over time. Why you want to think about owning them in the first place. Boards are getting their act together, a record number of share buybacks and discounts. There are still some discount opportunities out there. I think Peter was saying that. So the core strengths of investment trusts remain. So, Peter, I don't know if you want to do anything to add to that. These are my views, by the way, they're not industry views. That's what I think. Do you agree with all that?
Yeah, I mean, Jonathan, undeniable. All of these are good points. The one other thing I would say just for the audience, so you understand about active managers and outperforming, and just thinking of the UK here, but it's definitely true in America as well. When the biggest companies, Jonathan mentioned them in the US, in the UK we're talking about the FTSE 100. And when the FTSE 100 outperforms the 250, which is mid-cap companies, or small caps, or the AIM index, that makes it harder for active fund managers. Why is that? Because, well, you see what's happened to the oil price. So Shell and BP have done very well. How big is Shell? Yeah, I don't know, 7, 8, 9% of the FTSE 100. So for an active fund manager to benefit from Shell's performance, you have to be overweight. So you'd have to own 10, 11, 12% in one stock. And you could say it's same with HSBC banks. Banks have done really well over the last year or so. Same point. It's a massive company. It's a huge chunk of the FTSE. So when the very biggest companies, even within the FTSE 100, perform the best, active fund managers will underperform. They tend to look for smaller companies, and undeniably it's easier to go from 5 million to 10 million in profits than it is to go from 100 million to 200 million. Then that's fine if you can find these companies. They rely on the economy being in decent shape, and there's always been worries about what's happening to the UK economy. But when you start seeing the 250 index and small cap index doing better, as over the last 100 years they have tended to, not the last 5 years, but over the last 24, they've outperformed, then active fund managers will outperform, and we'll be here in a year's time saying, oh, here's a whole raft of not just smaller companies' funds, but general funds that are outperforming. At the moment, it's uphill and into the wind for fund managers there. So it's just worthwhile bearing that in mind. And you'll see comments in the FT, Times, Telegraph about small caps starting to perform. That's when active fund managers will genuinely add value. And the discounts you'll see in share prices of small cap trusts will tighten. And my own personal favourite, the one I look as a bellwether, which is presenting today, is Mercantile. It's a big trust. It's $2 billion. It invests mainly in mid-caps. It's a very sensible fund manager, good fund manager, Guy Anderson, JP Morgan. It's selling on, I'm going to say, a 9 or 10 discount. When you look in the FT, say, oh Christ, it's now on a 3 discount. And when that share price has gone up £1 since I last saw it, you'll know that turn has begun to happen. And I think it's a great trust to just keep an eye on. And it's a good trust on its own anyway.
Thank you, Peter. So I've got some more slides here which you'll see. If you sign up the newsletter, you will get all this, and you get all the other things you get with the newsletter. And I'll put in a big slide pack, which will have all the numbers around investment trusts. So, Peter, I'd like to thank you very much for your contribution. I'd like to thank you all in the audience for being so patient. You're probably like me, rather desperate for a cup of tea or something stronger in case of my friend in Scotland. And it's so good to see so many people here and to have waited so long all day. So thank you very much, and I hope to see you again next year.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.